My name is Slam Shady. My name is Slam Shady.
Hello, grade 12 accounting. This is chapter 10, video 7, and this video is about natural resource amortization. Today we have Jeanette, Sadia, and Jeff talking to you about stuff.
Natural resources are long-lived assets and are distinguished by two common characteristics. First of all, they are physically extracted in operations like mining, cutting, or pumping. And secondly, they are replaceable only by an act of nature. Some examples of natural resources are standing timber and underground deposits of oil, gas, and minerals. Natural resources are frequently called wasting assets as well.
Future removal and site restoration are the costs of returning resources as closely as possible to their natural state. Because the environmental legislation requires companies to protect the natural resources, companies are required to address issues such as site restoration, reforestation, and environmental cleanup. The matching principle states that restoration and removal costs should be estimated in advance and allocated over the useful life of the natural resource. This means that if your company is doing a restoration project, they can't just write off the cost at the end. They have to allocate it over the useful life of the natural resource.
Amortization for natural resources is calculated the same way as amortization for property, plant, and equipment. The amortization cost is affected by the residual value and any future removal or site restoration costs. We do not use the term depreciation, we use the term depletion. Amortization is usually calculated for natural resources using the units of activity method, which you would have learned about in the previous video. The formulas are as follows.
The formula for accumulated amortization is the cost minus the residual value of the natural resource divided by the total estimated units, then multiplied by the number of units extracted and sold. The formula for liability for restoration is the restoration cost divided by the total estimated units, again multiplied by the number of units extracted and sold. Lastly, the amortization expense you can get by adding the accumulated amortization and the liability for restoration.
For natural resources, the units of activity method produces an amortization expense that is unstable from year to year because of multiple variables. Things such as units sold and total estimated units fluctuate each year and are therefore random.
The cost of purchasing Fangorn Forest was $4 million. After Saruman Limited is finished decimating the forest, its residual value will be $250,000. Saruman Limited is only willing to pay $500 to restore Fangorn Forest. There are exactly 12,005 trees in Fangorn. During the year 1418, Saruman cut down and sold 750,000 trees.
So, to answer this question, first we need to calculate the accumulated amortization. As you know, this is cost minus residual value divided by total estimated units times the number of units extracted and sold. So, as we know, the cost of the forest is $4 million, and the residual value is $250,000. So it's $4 million minus $250,000 divided by the total estimated units, which was 12,005, times the number of units extracted and sold, 750,000. And this gives us a total of $234,374.90. Next is the liability for restoration. As we know, Saruman was only willing to pay $500 for restoration costs. So we have 500 divided by total estimated units, which is 12,005, multiplied by the number of units extracted and sold, which is 750,000 again. And this gives us a total of $31.25, and Sadia just put something in my hair.
Oh my god.
We add these two totals together to get the amortization expense. So we add $234,374.90 plus $31.25 to give us a grand total of $234,406.15.
So the journal entry for December 31st, 1418 is as follows. There is a debit to amortization expense for $234,406.15. And then credits to both accumulated amortization and liability for restoration. The amount for accumulated amortization was as we calculated $234,374.90, and the liability for restoration value is $31.25.
So this is what the accumulated amortization would look like on the balance sheet for Saruman Limited. As you can see, we have the capital asset Fangorn Forest less the accumulated amortization, and those two give you the net book value, which is $3,765,625.10.
For your trying pleasure, Diane's Diamonds purchased a diamond mine from Rihanna Company for $5,800,000. The mine will have a residual value of $500,000. Diane's Diamonds will pay $300,000 in restoration costs. There are approximately 15 million diamonds in the mine. During the year 2084, Diane's Diamonds sold 400,000 diamonds. Prepare the journal entry for July 3rd, the company's year end.
By now, you should know what natural resource amortization is. You should know how to calculate amortization expense and how to journalize for the amortization of natural resources. And you should also know how to put natural resource amortization on a classified balance sheet.
That's all for this video. This is Jeanette, Jeff, and Sadia signing off.
That's all, folks. Hell yeah.
YOLO.
Boom.
Shakalaka.
We got swag.
Swag.
Fabulous job. Just fabulous.
Why, thank you,
So
Bonsa.
fabulous.
Let's go have a jib jab and have some tea and crackers.